Welcome back everyone to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Well, a topsy-turvy session, but a session that is currently encapsulating the mood of the market, and that is that Santo India will continue to outperform no matter what happens. Whether there is a volcano eruption or a financial system is melting down, we do not care at this point of time, because even after a very, very weak start, it seems like we are going to end the day in the green. If you look at the Nifty and Sensex, they're currently quite firmly in the green territory, largely driven by the optimism for the domestic economy. But the global cues also have recently, in the past 1 hour, have become a little supportive. If you look at the Dow futures, they were well above 200 points at this point of time. So clearly adding to the momentum that we are seeing on the Wall Street. And lastly, Santo, I think it's the strong earnings that we have seen so far. The report, even from a sector like IT, which was so chastised in terms of growth fears and whatnot, it clearly shows that at this point of time the earnings momentum is in favor of the bulls.
Well, yes, at this point clearly bulls are ruling the roost. Nothing seems to affect them at all. But that said, CJ, I would still be a little cautious and even skeptical, because India cannot be a complete, this outlier theory that no matter what happens to the rest of the world, India will continue to shine. I think that's a bit far-fetched at this point. Also, CJ, let's not forget about valuations in this whole thing. Nobody is saying that India is exactly cheap. So you're buying something because you feel India is placed relatively better compared to other economies. But that said, how much more would you want to pay for the
Santo,
stocks?
outperformers are never cheap, are they?
They are not cheap, but at some point valuations, people will start talking about valuation, and I think that is when maybe the party might just come to an abrupt end. And the other slight warning signal which I see is the huge buildup of retail long positions in single stock futures. See, once in a while probably they may steal a march over FIIs, but it's always asking for trouble building up that kind of positions, especially in a market that is very, very volatile.
Santo,
so
if the past 18 months have taught us anything, is to never doubt the might of retail investors, at least in this market. So I don't know, maybe the tide is turning, maybe the game has changed, we never know. But clearly, it seems like the market is holding quite well, and I think that will give a lot of heart to investors. That said, let's quickly move on to some of the stocks that are in action, Santo, and starting off with an auto name.
Yes, ZF Commercial Vehicle System. Now, the company is a leading provider of driver line and transmission systems. Now, ZF Commercial is a play on the recovery that we have been seeing in the commercial vehicle segment. If you look at the numbers being posted by Tata Motors, Ashok Leyland, all these numbers have been pretty strong, clearly indicating that the CV segment is finally coming out of a very prolonged downturn. Now, clearly the CV segment is turning around because there's a visible pickup in construction, mining and infrastructure projects. The government is also trying its best to push to get the economy moving. Now, the strong point of ZF Commercial is that it's got technologically advanced products in its portfolio, which according to Moneycontrol Pro analyst Nitin Agrawal puts it in a good position to bargain with original equipment makers. This is something that most auto ancillaries are not in a position to do. So some of the products which ZF Commercial is into is avoidance of driver accident system, trailer electronic system, electronic braking system, electronic stability control, which is the control needed when vehicles turned around steep curves, fleet management system, and EV parts for buses. So it's got quite an impressive range of products out there. And most importantly, the company has managed to keep its margin steady for almost 6 quarters. The margins are slightly off from what they used to be 6 quarters back, but since then it has managed to hold it steady. That's mainly because of the bargaining power with OEMs.
Well, Santo, I think clearly if you look at it from a fundamental perspective, there is not really much that is against the company at this point of time. The CV cycle has just gotten into, it probably is still in its infancy. If you talk to a lot of analysts who are covering the sector, and they will tell you that they are just right now just seeing the beginnings of a new cycle, and therefore I think it would be a little foolhardy to bet against that sort of a tailwind. But that said, if you look at it from a technical point of view, Santo, I think in the short term I would be a little cautious on the stock, because if you look at the outperformance that the company has given the past 1 year, even in the past 6 months, clearly it seems like a lot of the optimism has been built into the stock performance right now. Recently the stock has fallen below its 5-day moving average. It's a very, very short term moving average. If you look at that, I think there is possibly some chances of profit booking on this counter in the coming days, and therefore I think in the short term maybe it could provide long-term investors some sort of, opportunity to bargain hunt. But if you're a trader, maybe you're looking for a tactical sort of a bearish position on the stock in the near term.
I thought you would raise a question with the issue of high valuations. At 40 times forward, it is fairly.
No, I don't think so. I have no issues calls with high valuations, and also because I think, this is a company which was erstwhile known as Vapco India, right? And if I'm not wrong, they also have I think they have an international promoter, and they are the Indian arm. And generally in India, these sort of companies tend to command a better valuation, largely also because of the high corporate governance standards that they also have. So I think in that sense, given the growth opportunity, given the corporate governance, you would expect that these sort of valuations probably will be something that will not discourage a lot of the long-term investors out there. Well, talking of big companies and giants, the first stock on my radar today is HDFC, or Housing Development Finance Corporation. Now, we know that the entire news flow around HDFC Santo over the past 6-7 months has been around that big impending merger with HDFC Bank. But I think that merger itself could be a big trigger for sell-off going ahead, because the stock is likely to exit the Nifty 50 in the coming 3 months. If you look at some of the dealers I've been speaking to, they are suggesting that traders are already starting to build up short positions on this counter, expecting a large amount of outflows from a lot of passive funds that track Nifty. Now, Nuvama Wealth, which is one of the brokerage houses, they came out with a note yesterday, Santo, suggesting that the HDFC could exit Nifty as soon as January. I mean, probably as soon as mid-December to as latest as mid-January. And when the exit does happen out of the Nifty index, it could result in outflows of as much as $1.5 billion, which is a big amount, right? And therefore, I think it is very, I mean, a lot of the traders out there would be probably rubbing their hands, probably looking to short the stock, and then maybe picking up at the bottom when the passive funds, enter the market. So I think this is one stock to look out for over the next 3 months.
Well, CJ, I don't see how the stock can fall too much. I mean, the condition certainly seems to be against HDFC at this point in time, especially moving out of the Nifty means that a lot of passive funds tracking the stock will reduce their exposure. But remember one thing, CJ, right now HDFC is more of an arbitrage play. Its fortunes are linked to that of HDFC Bank. The swap ratio has already been set, which means that at any point in time when the price corrects very sharply, there's some kind of buying coming. There's some kind of buying likely to come in, because there would be an arbitrage opportunity very clearly there. So I don't think you can look at HDFC at this point in time completely in isolation. It may fall, but at the same time the downside will be cushioned by more arbitrages getting into the act.
That is true. I think it will be a tug of war between the arbitrageurs as well as people who generally tend to play the index inclusion exclusion sort of a game every quarter almost. And it will be very interesting to see how HDFC emerges out of this, because I think the merger itself is, as you mentioned in the morning, Santo, that will still take at least another 2 quarters or 3 quarters. But the likely expectation is that by the first quarter of FY24 is when we can see the merger taking place or taking shape. So there is still a lot of time for that merger to happen, and therefore I think it will be very interesting how the stock performs in tandem with HDFC Bank going ahead.
Well, next stock on our watch list is Sterling and Wilson Renewables. Now, CJ, the choice of the stock might surprise you a little, considering that the financials of the company have been simply going from bad to worse. Stock has been underperforming. It had a lot of problems earlier on. But that said, CJ, if one were to take a really long-term call, probably then Sterling and Wilson Renewables is probably one stock that one should keep on the watch list. Now, it's a global pure play end-to-end renewables EPC solutions provider. Besides that, the company is eyeing opportunities across the entire renewables chain. It is trying to get into battery storage and also on building research and development capabilities related to clean hydrogen. Now, the company has been mainly hit because of the sharp rise in raw material prices, which has made many of its projects unviable, and which is why you're seeing the hit on the financials for the past many quarters now. Because of the sharp increase in raw material prices, what the company has been doing is it's been very wary of trying to bid aggressively for global projects, and it rather decided to stay in the within the domestic sector itself. And recently it has managed to win a major order, about 2,200 crore, more than 2,200 crore worth of order from NTPC Renewable Energy. So things are slowly beginning to look up for the company. It is still a very long haul ahead, but if you look at the stock price, CJ, it's not been falling much despite the steady deterioration in financial, as the company seems to be following a kitchen sink approach right now, cleaning its balance sheet as fast as it can. The stock seems to have stabilized around 296 levels, which means that maybe the worst is probably discounting in the current price.
Maybe Santo, it is possible, but I think, you know, with a company like Sterling and Wilson, and given the space that it is in, which is the renewable energy space, I think you could still wait it out before you could, you know, enter the space, because you can still, you know, wait for that execution to come in, those earnings momentum to kick in, and even if you are behind by maybe 1 or 2 quarters, 3 quarters, I don't think you're going to miss out on a big opportunity, because the opportunity size within the renewable space is just so large that a lot of people would look at this as a beginning of a new cycle, right? And I think therefore, instead of trying to get in early and get a little frustrated in terms of why the stock is not performing, even when earnings have started to get better, I think investors could wait for the guarantee of the execution of the performance and maybe then get into it or look into the stock going ahead. So for me, yes, no qualms that probably the worst is in the price at this point of time, but will I jump in? I don't know, not so quickly. Well, that said, the next stock and the last stock on my radar today is a Gujarat-based, real estate company, which seems to have gone under the radar, Santo, recently. Arvind Smart Spaces is the stock that I'm talking about. Now, this is one stock which is likely to see a bit of a turnaround in earnings in the coming quarter. At least that is the expectation from some of the analysts out there. They believe that the realization of the company are likely to improve, and that is going to happen because in the past 1 year or 2 years, majority of the pre-sales that the company was booking, Santo, was coming from low-value projects in Ahmedabad and in Gujarat. But going ahead, some of the pre-sales that the company is going to book are going to be from high-value projects in cities like Pune and Bangalore, and that is going to be a good kicker for margins for the company. Apart from that, Arvind, of course, has almost 7 to 8 projects that are on the pipeline, and out of this, almost 5 to 6 projects are already viable. And if you look at it, you will generally think that a real estate company would have to borrow more to get those projects kick-started. But I think I would not be concerned about Arvind on that respect, because the balance sheet of the company is very strong. The company has made efforts to bring down its debt. It has improved its cash levels, and I think that puts them in a very, very strong position to go out and get good deals as far as borrowing or loans is concerned, and then get on with these projects, and that will of course be a virtuous cycle for the company going ahead.
Well, two things I will agree with you, CJ. The company has managed to bring down its borrowing levels quite sharply, and the cash flows are also pretty decent at this point in time. What slightly catches, I have a quibble with is the sharp fluctuation in operating margins across quarters. It's been from anywhere between 13% to 27%. Now that's quite some wild swings. So even in quarters where the company has reported low earnings, somehow it has managed to maintain its operating profit. But at the same time, if you see, the volatility seems just too much for me to stomach. So this is something I would still give a wide berth to, CJ. Last stock on a watch list is GNFC. Now the stock just caught my attention, CJ. You're seeing a huge build-up of positions here. Futures in the futures segment. Now it has risen to about 89% of the market-wide position limit.
And what's that?
So what this basically means is that the futures and options position in a particular stock can go up to 95% of the market-wide position limit, which means that if the free float, let's say assume it's 20 shares, it means that 95% of those 20 shares can be that's the maximum position.
So 18 shares. The moment it reaches
18 shares, trading is further. Fresh positions cannot be taken. Cannot be taken.
Okay.
And what the price and volume trend indicates at this point is, CJ, this build-up of short positions. So once it reaches 95%, it means that those who have gone long will have no option but to square off at whatever whatever price that they can get. This is probably a kind of a bull trap, is what it seems at this point in time.
But Santo, if there has been a short build up, I would also expect that those who are holding short position will also have to start squaring off their positions. So for me, I will probably, maybe it may not be too much of a negative for GNFC, given that both sides will have to square off, so that the market wide position limit that you talked about comes down to, what is the level that it needs to come down before trading can, or fresh positions can be taken?
It has to come down to at least 90% before.
90%. So yeah, I mean, there is still good leeway, right, for it to come down, and therefore maybe we will have to wait and see whether there were more shorts or more long. If there are more longs, then the stock will definitely fall in the cash market. You will see that effect happening in the cash market. But if there are more shorts, then maybe there could be a short squeeze. So my fingers would be crossed that there are more shorts in the system than more longs at this point of time.
See, the thing is, if you look at again the price chart, the stock has been unable to sustain at higher levels. In April, it had rallied all the way to 800 plus. Then it fell equally sharply to sub 700. Then it rallied again, and it is,
I mean, just like any other PSU stock, Santo. I think that is very characteristic.
So, but in this case, again, few PSU stocks have seen this kind of volatility. Most of the PSU stock, the central PSU stocks which you see, they have a clear trend one way or the other. This has been something very different. It's been very, very volatile, and which is why I think, CJ, there could be some interesting price moves in the stock in the days ahead.
Well, Santo, I think if you look at it fundamentally, I think GNFC, there is a good argument from a fundamental perspective, given that the company is trying to get into a lot of new minerals, rare earth minerals that the company has been talking about, that they want to get into that sort of space. And I think there also, one of the reasons why the stock was doing also so well is because the earnings also have seen a bit of a turnaround since the new management came in back in, I think, 2019-20, if I'm not wrong. So for me, I think from a long-term perspective, maybe this is one stock to, just keep in your peripheral vision and see how the earnings trajectory is, developing or evolving. And maybe if there is more, certainty coming in, if of course there is more stability coming in the earnings, maybe the stock performance will also start, exhibiting that going ahead, and maybe it will not bother you as much as it is bothering right now with respect to volatility.
Well, and that said, let's quickly take a look at the market. Nifty has managed to stay near the day's
we are
high.
Near
it's
the
up
day's
about
high
132 points. That's quite a strong comeback. The Sensex is up about close to 500 points at this point in time. Overall, all-round good performance by the bulls here. Canara Bank is among the big gainers. The stock is up close to about 5%.
Yeah, and Santo, I think you can see the market's mood is about punishing the good earnings performers and, punishing the bad earnings performers, of course, and rewarding the good earnings performers. If you look at Oberoi Realty at this point, the stock is down almost 5%. So clearly, market is not happy with that.
Siemens is another stock which has taken a beating after this
DMart is another stock which has also taken a bit of a beating today.
I was surprised by the beating that DMart.
Yeah, I think there are concerns about the margin, the contraction in margin that the company has seen in this quarter, and I think that is what has bothered investors a little bit. But I mean, of course, if you look at the headline numbers such as the top line and the bottom line, clearly there is cause for optimism as far as DMart is concerned. Santo, if you look at the mid and small cap space, I think that is one space that is sort of underperforming a little bit in terms of the benchmark indices. Nifty Mid Cap 100 Index is only higher by 0.1% or 0.2% actually, and the Nifty Small Cap is higher by about 0.4% at this point of time. So clearly the broad market is suddenly lagging behind when, just a few weeks ago, we could not stop raving about the fact that broad market indices were actually outperforming the large cap indices. And maybe this is signs of the times, that maybe investors are a little bit cautious going gung-ho into riskier names in the middle small cap space, and maybe they want to have the safety of the large cap names.
Well, with mid caps, always the moves are very sharp. You see very sharp build up, and when the prices correct, they correct very sharply, and that's mainly because of a lot of margin calls kicking in simultaneously. And when some bit of price damage has been done, again it takes some time before the bulls again manage to muster confidence and then start slowly building up their position. So this is not really surprising, but if the overall mood remains positive, if Nifty is able to maintain its uptrend, then again you could see mid and small cap stocks performing like they did about a couple of weeks back.
I was talking to actually a PMS manager, fund manager, just before coming to the show, and he was like, I'm out there hunting in the middle small cap space because for me, there are no dearth of opportunities at this point of time. And so clearly, I think as the market is always, and that is the beauty of the market, there are always diverse views out there in the market. That's the Santo. A very interesting question has come in from one of our viewers. Sayan Sain has asked us whether in this current, environment of higher interest rates, whether it is a good time to invest or go big in the FMCG space.
Well, typically, whenever interest rates rise, it's never been good for stock markets, for equities. You've seen some bit of pullback there because then you have better returns, at least better returns relatively the kind of heartburn that you would have to go through when you're investing in equities. So far, we have not seen a big shift because equities clearly are outperforming at this stage. But whenever market takes a turn for the worse, a lot of money then flows into defensive, because the defensive stocks, FMCG being one of them, because these are the kind of stocks typically that won't rise much in a rising market, but at the same time they won't fall much in a falling market either. But that said, if you are looking for good strong returns, then it doesn't just make sense to invest in FMCG stocks at these levels, particularly given that they've already had a very good run up. It shouldn't be looked at as purely a place for hiding, is how I would say. If you're just looking for a place to hide, then maybe FMCG stocks make sense. But if you're looking to really grow your capital, then probably you will need to look at the valuation bit also, valuation part of it. And I feel that probably it is slightly on the expensive side. CJ, your view?
I mean, Santo, I think clearly FMCG stocks have always been very expensive in India, at least in the past decade and a half, because of the sort of growth and the consistency of earnings that they have been providing. Yes, recently there have questions emerged whether the sort of growth that we are seeing, the about 10 to 12% top line growth that we are seeing for the past 2-3 years, whether that justifies 70 to 80 times of earnings, 1 year forward earnings premium for these sort of stocks. But I think in general, if you look at the FMCG space, it is still a growth story. I think it's still an aspirational story for India, and in India, consumer business will always tend to do better, much better in terms of valuation, in terms of returns, in terms of earnings growth, compared to some of the hard industries, as you call them, such as infra and other. The other day, Santo, I was at an industry event, and Samir Arora was there, and he was like, the most money I have lost is actually in the infra space. So that goes to show that in India, consumer businesses tend to be safer, and we always tend to pay that extra buck for quality, and that is why the valuations are at such a premium.
But again, it is hard to generalize there, CJ, because you could have invested in HUL sometime in 2000 and then not made any money for the next 10 years. You could have invested in ITC again, which has not been making any money for quite some time. So it depends which stock you get into, how much you commit, and how long you hold it. So it depends on a multiple.
Absolutely. You can't use the same brush in the market. You will always have to be stock specific. Do your research, always DYOR, as we all call it. And I mean, sometimes you also need a little bit of luck.
Definitely, CJ. Well, that said, what are we keeping an eye out for?
Well, Santo, earnings, of course, basically not many big names, but some of the mid to small cap companies will be reporting their earnings, second quarter earnings tomorrow. And some of the interesting names to watch out for would be Polycab India. You have Mahindra CIE coming out with its numbers, as well as Tata Communications. To watch out for that. On the economic front, there are not too many big data points coming out. Of course, they were supposed to come out tomorrow because China was supposed to release its Q3 GDP number and retail sales number, but that plan has now been put to hold because of the ongoing Congress there. So very surprising developments there, given that it's very rare for China to postpone reporting of economic numbers or economic indicators, and we will have to see whether there is no canary in the coal mine, just the way it was in the UK bond market.
Well, and with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and please do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, there's only one destination, moneycontrol.com, and also download the Moneycontrol app. We'll catch you again live tomorrow morning at 9 a.m. Till then, have a great day.